About 2 weeks ago, I made a video about my so-called Market Equilibrium Indicator, or short MEI, a custom indicator that combines all of my trading strategies that I use for trading longer-term Forex options into one powerful tool that simply displays buy or sell signals on a TradingView chart. I also invited you guys to test the indicator for free, and so far almost 100 of you have joined the open beta test, which will still continue until the end of August. If you also want to join the beta test, you'll find a link in the description and pinned comment of this video. Parallel to the test, I started trading a $10,000 account with small positions and posting the trade setups plus results to a Telegram channel. Because, it's always one thing saying that you have this super awesome indicator, but another one to prove it by publishing the trading results. Currently, I am trading the indicator on 4 different assets: 2-minute Popcat, Doge and Ripple charts, and the 15-minute Bitcoin chart. The results so far have been nothing short of amazing. Out of the 17 trades I took so far with the indicator signals, I was able to close 16 in profit, a success rate of 94% so far, which is something I've never encountered before and really beats all of my expectations. However, while many of the beta testers also reported that the MEI works very well for them, some beta testers are struggling to achieve similar results. That is why in this video I want to walk you through some of the trading setups and explain my own way of trading with the MEI indicator. Which signals I trade, which ones not, and how I handle take profit, stop loss, and how my personal approach to risk management and money management is. I hope that at the end of the video you will have a better understanding of how and when to use the Market Equilibrium Indicator. First of all, before even looking at potential trading signals from the indicator, we need to talk about some fundamental things when it comes to trading with actually any indicator or trading strategy. No indicator, also not my MEI, is a turnkey fire and forget solution that always works on all time frames, all market settings, and will basically make you rich on autopilot. You as the trader are always responsible to judge if a signal has enough profit potential to justify trading it. Let's look at an example for this. The last 2 signals the MEI generated for the 15 minutes Bitcoin US dollar chart were a buy signal on August 11th and a sell signal on August 13th. Just by looking at the chart, would you have traded these signals or not? In my opinion, only one of the 2 signals was worthwhile trading. The buy signal on August 11th was directly above a zone of support from the 1-hour time frame with plenty of space until what was back then the next level of resistance. This is a very good setup that I would trade at any time. However, things are very different with a sell signal on August 13th, simply due to the reason that the signal kind of appeared in an area where the next logic profit target, the now zone of support, was just too close, 300 to 400 US dollars, to where the signal appeared. While the signal, technically speaking, still worked out to be profitable, I did not take the trade due to the profit potential being too low. Look how the market bounced back after hitting the zone of support so far. We can get an overview of these higher time frame areas of support and resistance by either drawing them manually onto our chart or by using, for example, an indicator called Support Resistance Channel Zones Multi-Time Frame, which is freely available on TradingView. For the 2-minute charts I am trading, I always choose to display support and resistance zones from the 1-hour time frame, for the 15-minute Bitcoin chart from the 4-hour time frame. Play around a bit with the indicator to find a setting that best suits your own trading style. Let's look at another example. On the 2-minute Popcat perpetual contract, I traded a sell signal yesterday evening. Again, I took the trade because to me it appearing just above a support resistance zone indicated that the price might reverse very quickly to the lower band of that zone. My short entry was at 0.5719 and my profit target was at 0.56. The market then quickly reversed to my take profit just to bounce back at 0.5604, so missing my take profit by 0.0004 US dollar, which is something that is obviously annoying but will happen every now and then. I manually closed the trade then at 0.5672, which still left me with a small profit. The buy signal then again was something I did not trade because, same as with the Bitcoin signal I mentioned before, the signal appeared nowhere close to support or resistance and did not leave much space until a natural point of take profit. However, notice also here that technically both signals would have worked out fine with having a bit more patience on my side. As trading with this indicator on lower time frames is also for me still a new experience, patience is something that I'm currently still lacking a bit. So, in summary, in order to separate the good signals from the bad or average ones, you need to analyze if the signals appear in confluence with support and resistance levels. As you saw in the last two examples, my take profit usually is the top or bottom of a support or resistance zone. But where do I place my stop loss? This topic is a bit more complicated and maybe even controversial. If we would trade the market equilibrium indicator on higher time frames, such as 4-hour or daily charts, so basically for swing trading, the answer would be simple. Look for the next level of support and resistance for your stop loss and then measure if your take profit is at least 1.5 times farther away than your stop loss to have a positive risk-reward ratio. But since we are trading mainly 2-minute charts or a 15-minute chart, these classic risk-reward ratio strategies do not work so well anymore. It is, from my experience, a bit like when you compare the physics of Isaac Newton to quantum mechanics. In Newtonian mechanics, particles and waves are different entities, while in quantum mechanics they are two sides of the same coin. My personal approach, which by the way you are welcome to disagree with, is to approach risk management over the position size I am trading. As you may have seen earlier, the position sizes I'm trading with a 10,000 US dollar account are rather small, only 1,000 US dollar per position. So I'm not utilizing leverage at all. In fact, I am trading a leverage of only 0.1, 10% of my account size. I do this because I personally like to scale into some trades like, for example, these signals in the Dogecoin perpetual contract, where there are so-called signal clusters. Areas where two or more signals appear in the same direction in a very short period of time. In this case, I would add another $1,000 to the first position when the second signal appears. That way I can utilize these signal clusters and slowly scale into the markets, all while still trading rather small position sizes. In addition to this, I work with a fixed daily stop loss, meaning should things really run against me and I'm down 3 or 5% for the day, I completely close all positions and stop trading for the day. This typically could potentially happen when sudden and unexpected news hit the markets, such as a much better or worse US inflation data reading. However, I usually do not trade anyways on days where important data like this is published to avoid these sudden moves that nobody, also no indicator, can forecast. So usually my risk-reward ratio will be below 1 for intraday trades on the 2-minute charts. However, this is overcompensated by the high success rate of the signals if you only trade signals that are in confluence with support and resistance. Take it slow, especially if you are a beginner with trading. Trading on the lower time frames can be very hard as you're in direct competition with other pro traders out there. So instead of trying to trade 10 or 20 assets at the same time, rather first concentrate on 1 or 2 assets until you start feeling more confident in deciding which signals to trade and which ones not. It is totally okay to first practice on a demo account, and once you use your own real money, trade small position sizes. Remember, trading is a marathon and not a sprint. All these stories on social media about I earned 100k last month from trading from so-called influencers are usually fake. The real pro traders know that long-term success comes from small but continuous profits and not from these one-time high-risk 100x leverage trades. The road to completely living off your trading profits is very long and has a lot of obstacles, especially on the mental side. Your first goal should maybe be instead to make these extra $500 or $1,000 per month on top of your normal job salary. Once you're able to do this consistently, you can think about scaling things up. One final word of advice: do not use the signals of the MEI indicator on long-term crypto or stock charts, such as daily, weekly, or monthly charts, as it does not work well with assets that exponentially increase over larger timescales. That being said, feel free to opt into the open beta test and join the Telegram channel to find out for yourself how the market equilibrium indicator can also help you to transform your trading to becoming a more professional trader. Also feel free to ask any questions, either here as a comment underneath the video or by sending me an email or a DM on Telegram. Until we see each other again, happy investing.